Mr. Manzullo?
Thank you. I appreciate your coming here. Mr. Ollendorf, what did your bank do to bring about this crisis in finance and home mortgage?
Congressman, very little.
Mr. Bates?
Unfortunately, we were just kind of participating like a community bank for 95 years has participated, and something happened. I'm not sure what.
Mr. Bates? What'd you guys do wrong?
Absolutely nothing.
Mr. Raw? Mr. Wren? I closed over 1,000 loans. I practiced law, represented a couple of banks, and even before RESPA, when you had the three pages like that. And when you go to closing nowadays, people don't read them. You can't. If you don't sign them, you don't get the house. So now we have more and more regulations, including with the appraisers going on. We've been fighting RESPA for years. When MERS came along, we fought that like crazy because of with the electronic recording of mortgages. You could no longer track who owned the note through the county office on it. And as I see what's going on here, the Fed has always had the authority to govern underwriting standards and documents to the extent that it has authority over banks. And it wasn't until 2 years ago that the Federal Reserve actually came out with a rule requiring written proof of a person's earnings before a person could borrow. The GSEs, either as to the loans they would collateralize and sell in the secondary market or hold their own portfolio, have always had the authority to have underwriting standards as to the loans that they would accept. What did they do? They did nothing. Because housing went from a privilege to a right, then it became an entitlement. And at that point, all the standards fell. And so here we are with this biggest mortgage collapse going on because somebody didn't use any common sense out there, and the people who did not cause the problem are now, many of them are sitting before us saying, you have to do something. We had a hearing, Mr. Chairman remembered, I think it was last week, with the acting director of the Consumer Financial Protection Board. And he said they were examining over 10,000 transactions as to which they're trying to determine whether or not they have authority. I mean, this is outrageous. But I would like to, Mr. Ollendorf, ask you another question. And I come from Northern Illinois, North Central Illinois, and the president of Forreston Bank is here, and I am very, very disturbed on page 4 of your testimony where you talk about the qualified residential mortgage, and if it's written, regulations are written incorrectly, then the farm credit system with direct lenders can come in and actually preempt and take away your business on that. Could you expand on that?
We're concerned about several of the new mortgage rules and the definitions of what they're going to be. In a community bank, it's easy to understand a 30-year plain vanilla mortgage, and I wish everyone qualified for one, but it just isn't the truth. If you're in rural areas like we are, all of our homes aren't cookie-cutter subdivisions where all of them look alike and they all follow the same rules. We have people with horses in a barn and other things like that. And so we've made balloon loans, which are just the way that we can portfolio that, hold the interest rate exposure risk to 5 years, and then refinance the product as 5 years roll on. And they're starting to define this qualified residential mortgage and then qualified mortgage, and what these terms will be and what the safe harbors will be. And our significant concern is as they define these terms, if they're defined too stringently, what's going to happen is a lot of the loans that we as community bankers have made and portfolio, which means we have the entire risk. The credit is on our balance sheet. If this loan fails, it's ours. And then you tie the mortgage escrow requirements in on high-cost loans. And the way some of those indices were set, which were set many, many years ago, with interest rates as low as the Fed has allowed them to drop, we're triggering on very normally priced loans, we're triggering into high-cost mortgage loan territory. And so now I'm saying to my customer, well, in order to give you this loan, we have to escrow your taxes. We've had these customers for 10, 15, 20 years, and they've managed their finances quite nicely, thank you, and they've managed their escrow. And now we look at them and say, well, we don't, in essence, what we're saying to them is, we don't trust you enough anymore to handle it on your own. We now have to add another layer of bureaucracy. And escrow is very, very expensive to offer. A lot of community banks aren't in that business because it's complex, it's cumbersome. And now I'm telling my consumer that, you know, we really don't trust you anymore. So what happens with all of these rules and regulations is the type of loans that we've made, we've been creative, we've helped people with unusual circumstances and situations become very successful. And now, because they're not cookie cutter and they don't follow what made these definitions turn out to be, all of a sudden some of those loans we're going to have a very difficult time doing. And again, I've heard bankers say, we just may not be in that business anymore. We're running out of businesses to be in.
My last question is, Mr. Schmidt, you have a unique background having come from the real estate industry. Why did these standards slip? Why did the normal loan-to-value ratio and the amount of down payment, what happened?
I don't know exactly what happened. Totally, might have been a little bit higher by pay grade at the time, but I was always told that the loans had to meet certain specifications and certain standards so that they could be sold on the secondary market, and so they basically had to be cloned. Okay, then I believe they had the ability. The secondary market began to buy them when they weren't necessarily cloned and weren't all the same, and it got to be agreed. I mean, we used to insure anything less than or more than 80% financing. Where it really got kind of absurd is when you would have an 80% mortgage, a 10% mortgage, another 10% mortgage, and then get a line of credit as you walk out the door of the close, and you know, underwater.
Yeah, during the height of the real estate heyday, about 25% of the mortgages were collateralized with the GSEs. Now it's about 95%. But the GSEs had the authority at that time to insist upon the strict underwriting standards. We're looking at these all-day and subprime mortgages, isn't that correct? Well, you would know, that's a matter of